All right, we are live. So, hello and welcome to the next episode of the CRE News Hour. It's a weekly podcast where we come to you live at 3 p.m. Eastern Standard Time to discuss current events and everything commercial real estate. My name is Henry Eisenstein, and as always, I have my co-host Rafael Collazo. How you doing?
Great, man. Can't complain. It's a beautiful day here in Louisville, Kentucky. We're wishing the best for Chad. He's feeling a little bit under the weather. I know he and his family are getting the seasonal flu. So hopefully he feels a little bit better for the next go around.
Yeah, I hear, everyone I'm talking to, I feel like, I hear the same exact thing. So we're going to knock on wood and we're going to stay healthy.
Yeah,
it's kind
of weird because, yeah, it's kind of weird too, because I mean, it's definitely not flu season per se, but there has been kind of a good amount of people that have just been getting it, and I know it's been here making its rounds as well. So hopefully it's just a quick turnaround. But today I wanted to kind of dive in with one of my articles that I pulled. I know we've talked about these communities in the past, but I thought it'd be kind of cool to just provide additional context and really just give better clarification as to what build-to-rent properties or build-to-rent communities are. Obviously, they've been extremely popular across the country. I think it actually references that the build-to-rent housing market is not just on the rise, it's skyrocketing. In 2023, there were more than 27,000 build-to-rent homes built, up 75% from 2022 and 300% from 2019. Again, it's becoming much more of a trend in markets all across the country. So in this article, it kind of highlights what exactly is build-to-rent housing. So it differs slightly from single-family home rentals in that oftentimes with single-family home rentals, they're located not necessarily all in one place, although they can be. Typically with single-family home portfolios, they're kind of spread across the city oftentimes, whereas these build-to-rent communities are literally designed to be rentals for people who are wanting to rent houses and have more space than an apartment. And they usually come along with a variety of different types of amenities. So they'll have the swimming pools. It kind of replicates like a gated community that has a bunch of different types of amenities. So it's kind of, call it an apartment, but also you have more space for your growing family, and you also have the access to all the different amenities that an apartment building would be. Now, the reason why a lot of these communities are so appealing is because it gives people flexibility to be able to operate or rent a space, have more space available to them as opposed to an apartment, but yet they don't have to worry about getting into a mortgage for 30 years. It kind of restricts their ability to sometimes move depending on their ability to sell the home. Let's say, so it gives people more flexibility than they're typically used to in a mortgage scenario. And then on the apartment side, it obviously gives you a lot more space to work with. Now, one of the biggest challenges that we're seeing on the build-to-rent community side, and really across the country, is just the cost to be able to develop these communities now. Because they're build-to-rent communities, developers for build-to-rent communities often can pay more than single-family home developers because they're obviously holding the property for a longer period of time, and their yield over that period of time is going to be better than a residential home builder like a Pulte or whoever else that needs to be able to buy the dirt at a pretty cheap price to be able to then sell it to an end user and maintain their margins. So, there's definitely some benefits to pursuing build-to-rent developments. Obviously, there's a lot of developers out there that are starting to focus in that. I think we talked about one time on the podcast that we've had a couple build-to-rent developers scoping out land sites here in Louisville. One of my colleagues is actually working with one right now that's looking for some dirt to build on. And again, the economics tend to make sense. So thought I'd just kind of open it up to you to kind of share some insights. If you've seen any of those in your market, I'm not sure if in Miami you're starting to see more of these communities popping up.
Yeah, I was curious actually if you could scroll up and try to see where these communities are most commonly
Located.
located.
I don't believe this one was kind of like an explainer type of.
Sure.
Let me see if I can pull it up.
Yeah, I would just be curious where this is super common because, first off, like I love the concept. I do believe we are going towards a renter nation. I am pretty bullish on that. I do believe that is, without a doubt, the overall trend that we are headed towards. I do believe that build to rent single family homes are a fantastic option for individuals who have a little bit more capital, who do not want to spend the money specifically on buying a home. Maybe they're not, traditional home buyers, right? They don't have that kind of mindset that they want to own, but they have some more money than the traditional, apartment type of tenant. And they want a little bit nicer of a place. I mean, thank you for pulling this up. I'm just reading from top to bottom. So Columbus, Ohio, Nashville, Tennessee, Salt Lake City, Utah, Orlando, Tampa, Jacksonville, Florida, Austin, Texas, San Antonio, Texas, Atlanta, Charlotte, Huntsville, Houston, Dallas, and Phoenix. Yeah, very interesting. Very interesting in the sense, like, I'm curious because, like, Denver is, like, shocking to me only because, like, some of these areas, like, these build to rent communities, I'm imagining they would be in probably lower price markets, right? Like overall lower price markets. But I also do believe there's probably some value even doing it in the because what I'm realizing is I think they're doing in the lower price markets because it just makes way too much sense to just sell them off, in higher priced areas where, you're going to make too much of a profit just to sell it versus keeping it as a rental. But I am curious to see what some of these margins look like. I mean, obviously in these types of situations, you're probably going to get substantially better rent where, if you get a 3-bedroom house versus a 3-bedroom apartment, you're probably looking at somewhere between 25 to 50+% in increased rent on a monthly basis. Plus you're going to have a lot less frustration because typically like they have a little bit more feeling of ownership when they're in, a single family house versus an apartment. And, almost every single time, 100% of the utilities are handled by the tenant. So it's also another positive for the investor. You're going to have a lot less probably utility costs there. So yeah, a lot of pros for sure. I think this is definitely where things are going. Also, if you look at where all those, no, you're fine. If you look at all those main markets, the other thing I was picking up from that was those are areas with a lot of land for development.
That's a big one.
You need to obviously have substantially more land. And so it's in, a little bit lower price markets, seemingly, at least where it seems like a large majority of them are. A little bit lower price markets, and then in areas with a lot of, rural land that they could develop. Obviously, and also areas where there's a lot of people moving to it, will be helpful. Yeah. Like obviously, because like you're not going to see it in Miami-Dade County. You're just not going to see it out here. I think it would be a fantastic option, but there's just no development opportunities. There's been, almost all the land is taken, and most of the land that they do acquire to develop, they just go straight up. So I definitely think there's a lot of opportunity in figuring out if you're in those rural markets, and you have some land opportunity, I think looking into single family rentals and finding out the developers that are actually spending the time, energy, and effort to do so would be a great option to look into.
Yeah, no, 100%. And to your point regarding the development side, so there's like different tiers of developers that they pay more for land. So the lowest form, not necessarily the lowest form of developer, but the developer that was going to pay the least amount for land is typically going to be your big box developers that are going to be like the Pulte's of the world that are doing these massive, residential developments and just, doing cookie cutter homes and selling them off. Then you've got your build to rent developers. They're typically going to pay more than, the cookie cutter developers like the Pulte's, et cetera. And then you've got the apartment developers are going to pay the most because they can get, more density. But oftentimes with these residential, apartment buildings, there's a lot of contention depending on where they're located in town. Not everyone likes to see apartments go up, so they can be a little bit more contentious of a plan to get through as far as development. So oftentimes, if you have two offers and you say, okay, well, one's an apartment developer, maybe they can pay a little bit more, but the process of getting to the finish line is going to be a lot harder than maybe going along with this build to rent community. It gives you that flexibility to know that you maybe have a little bit more security with one offer versus another. And that's going to be very crucial, especially if you start from an investment standpoint. If I'm acquiring land and parceling it off and I can flip it to a build to rent developer versus a Pulte or some of these other apartment developers, maybe that just gives you another avenue to explore for, potential end buyer for what you need. So
Yeah, and also like some townships, like you had mentioned, sometimes they just want homes, right?
mhm,
You have a big tract of land and they just desperately want houses to be built. They don't want apartments, and you just have to abide by their specifics. And a lot of people are just like, oh well, I could build several hundred homes here, so I'm going to call up a Lennar, Toll, or Pulte, not realizing that you actually can make substantially more money if you go the build to rent route.
100%. Couldn't agree more. All right.
Yes,
So next up is Northeast found to hold highest apartment rent premiums as Sunbelt offers discounts.
Yeah, I thought this was interesting. Obviously as a Northeastern at heart here, I thought this was actually quite fascinating, and I do believe this actually has to do with the fact that um, income, and again, this is just my 2 cents. Income, and I'm curious to understand why, like what they really believe this is due to, but at least from what I was understanding, they didn't have much explanation as to why, other than my assumptions to be, Manhattan, Connecticut, New Jersey seeing the same thing, Massachusetts seeing the same thing, seeing massive increases in rent because there's, just these are higher income areas, right? Like, and, most people are, they're not drastically affected, right? As much as the rest of the world is, Beverly Hills individuals are not worried about, as an example, are not worried about, the values of rent or, in this is, yeah, I think this is rent here. Yeah, multifamily. So like, it's not shocking, right? And most overpriced, underpriced multifamily markets. So like, this is just showing you like, people are going to pay a premium because they want to be in, New Haven, Connecticut. They want to be in Manhattan. They want to be, in these class A markets. And where you have places like hypothetically in Austin, Texas. In Austin, Texas, they also have like the most amount. I don't remember the exact figures, but the amount of development that has occurred in Austin, Texas is insane. And they have so much inventory. So it's like, you have so much product that's on the market and not enough people filling these apartments at fantastic rents. You have drastic vacancies. It's the same thing in even, places like Miami. The only reason why Miami markets, they will continue to go up is because there's just so many freaking people moving here every day. Even though they have such an abundance of supply here, no one seems to care. They'll still pay 5 caps. It makes no sense to me.
Yeah, yeah, and I mean, obviously, the people that are moving there are coming to secure higher paying jobs, and so what they can pay and rent oftentimes is competitive. Now, to your point regarding some of these locations, I was actually kind of surprised. Madison, Wisconsin. I'm not too familiar with that market per se,
Yeah.
but out of the ones that you've seen, obviously the Northeast, the New Haven, Connecticut's, the Hartford, I could see that. Obviously, it's a very densely populated area. Massachusetts, obviously New York City. Depending on which borough you're targeting, obviously I could see that being the case. I had some friends, post COVID that they got like killer deals on the rent. They got, obviously got a couple months of free rent. They had a reduced rent compared to what they were paying before. And now it's become super competitive. And I think one of my friends, his sister lives in New York City, and her lease before was like $4,200 a month, and then they bumped it up to like 5,000, like $1,200 essentially, raised their rent in 1 year. And they try to negotiate, and the landlord's like, no, we have like another person ready in line to come in. So some of these numbers don't necessarily surprise me. But yeah, I mean, I get to your point. I think what it comes down to is that, you know, it doesn't matter where you invest in the country. Obviously, it's important to invest in areas that that there's going to be growth long term. As we say, a rising tide lifts all boats. But that's why I think it's so important to get really granular in understanding the nuances of your local market, so you can make better decisions in the long run. Because
Yeah, for
again,
sure.
there's going to be fluctuations in pricing in every single market. So you really just have to make sure that you understand more of the local dynamics to ensure you're not going to get in over your head because you read in the newspaper that, oh yeah, like, Miami real estate is the next best thing since sliced bread, without understanding like the nuances of the area, so you could make the best decision possible. And you could
Yeah.
transmute, not necessarily just Miami, it could be Austin, Texas, Phoenix, whatever.
I also think there's a lot of value in looking at these areas. Like, I like buying existing product, not Class A product, not stuff that was built within 3 years. I like buying stuff that is built in the 50s, 60s, 70s, 80s, 90s, whatever, and I can come in and renovate the product. But that market is so proven in itself. It's like Northern New Jersey has, like, as an example, because it's my backyard. There's just so many freaking people moving there all the freaking time because they come from New York, right? And there's such a huge population. There's such a demand for more product that I don't know when they're going to catch up to it, right? And it's funny because, like, if people don't know, if you buy too far south in New Jersey, you're going to have you might have, drastic, like, you might not, it's not about might. You definitely will have a drastic difference in return metrics. So you can't pay anywhere near. But if you don't know these areas, they got huge investors that are buying for, like these funds that I was just doing some research on an industrial building, and some fund paid $400+ a square foot for an industrial building in a market where it probably should have traded for maybe 250, maybe 280 at most, right? And they paid 420. It's like, and this was a fund based out of Chicago buying a huge, $100+ square foot industrial building in Jersey. I'm like, these people have no idea why on planet Earth. I like, unless they know something I don't from being in this marketplace, which I honestly cannot make sense of how on planet Earth they spent that much money. I told my sales guys, like, you should call them and sell them every damn building we've ever found in this area, because who the heck is paying $400 a foot? Unbelievable. So it's like these people from outside the areas. Like, if I was going to invest in Austin, Texas, and I go, oh, I can find a 7 cap and maybe I can make it to an 8. I'm not thinking that might be a decent idea, but there's just so much freaking product on the market. Like, you're gonna struggle. Like, here in Miami, I would never buy something here in Miami. There's just too much product. They're building another 50,000 apartments. It's like, how on planet Earth? I think we have a huge lag time till that we're ever going to catch up. And obviously, like, there's still so many of these places you see. In Miami, I don't know if it's like one of those weird, never-ending, constantly growing markets. But in Miami, rent growth has gone down, but the sales growth hasn't stopped.
Yeah.
Right.
Hey, if you just buy some land in Brickell, and you'll be good, right?
Yeah, you can just be, what's his name? What's the hedge fund managers for Citadel?
Yeah, I know who exactly you're talking about.
Ken Griffin,
Citadel guy, Griffin.
Griffin. Anyway, this guy spent $700 million on 3 lots here in Brickell. And apparently they're going to be building, mass. I mean, you pay $350 million for a piece of dirt, 2 acres right on the water in Brickell. I mean, clearly he knows better than us, but I mean, betting obviously very, very long term. He'll be into that building for $1 billion, no problem.
Yeah. Well, I guess when you're worth 50 billion, it's 700 million maybe isn't a
drop in the bucket.
Drop in the bucket. That's awesome. All right. So next up is developer purchases half of Oakland A's stadium, plans a $5 billion redevelopment. So I'm not sure if you had a chance to get over to San Francisco and particularly the Oakland area. I actually was just out there visiting a good buddy of mine a few weeks ago. What's up?
It's been a minute, but my fiance's from about an hour south of there.
Oh, cool. Yeah. So it's a cool area. I actually got a chance to see the A's play when we went and visited. I'm not necessarily a big baseball fan. Like, I don't follow along per se, but I like to go to the games sometimes, especially if we're in an area where they have a historical stadium and stuff like that. So got a chance to actually go see the A's play the Marlins at the stadium. So this stadium has kind of been dilapidated for quite some time. It was built, I believe, in the late 60s, early 70s. Hasn't really been kept up with. The A's are actually going to be leaving at the end of this season and going down to Sacramento for 2 years or 3 years before they head over to Las Vegas. I believe they're going to, they're trying to build a stadium for them out in Las Vegas. So in this particular area, you have the Oakland A's stadium, and then right next to it, there was a stadium that the Golden State Warriors used to play at before they moved into the city to a brand new, really nice stadium on the water. So this has historically been like kind of a sporting complex. And this development group, African American Sports and Entertainment Group, bought half of the site from the Oakland A's owner, who also happens to own the site where the stadium was located, the Golden State Warriors, and they're trying to acquire the remaining half of the 112-acre property, and they're proposing a massive development that would incorporate a variety of different mixed use, so residential, commercial, entertainment, hospitality, and then they're also working out deals with United Soccer League. There's Oakland Roots that's there. They also are making a play to try to get a WNBA franchise. And then obviously if they're able to build a new stadium, maybe they could qualify for an NFL expansion team. Obviously that system's been proven in that market, so they could very well be in contention for that as well. So, I just wanted to share this article because it kind of showcases the willingness, and the city's working with them heavily. So they're actually trying to get incentives for them to be able to produce to create this development. The actual site is actually in a really good spot. It's just off the highway, great visibility. It could really be something cool. So, it may or may not apply to you per se, but it's stuff like this that you can see how, making a statement or making a play at something, even if it's not to this scale, you can really make an impact in your city. And oftentimes if it's an impact that's in a positive direction for the city may even consider working with you to try to get the project up and running, because at the end of the day, this is going to become a tax juggernaut, most likely for them, in a variety of different ways. So
I'm curious, right? Like, and again, if you guys are watching this, please comment down below. Why do you believe? Because it says here that the A's are not the first team to leave, right? Like, why are people leaving this area? Are they not having, clearly, it's not like the Yankees. You never hear like the Yankees are leaving Manhattan. Like you never hear, or wherever they are, right? Like with the Bronx, I forget where their stadium is, but like you're not hearing that. You're not hearing that the Yankees are leaving their stadium. You're not hearing, all these other, areas are leaving their stadiums. But this is not the first time a baseball team, I believe, has left this stadium. I'm curious why that is.
It's the Raiders left to go to Las Vegas. So that was, I believe, one of the first teams that left. Then the Golden State Warriors left because they got a new stadium. They're literally, both those stadiums are older stadiums, and the city of Oakland just doesn't have the same amount of resources that San Francisco does. And so San Francisco, to their credit, was like, hey, come over here. We'll help build you a massive, really cool stadium on the water with good parking and access and everything. And so, the Golden State Warriors took them up on it. So it's one of those things where they kind of just lured them across the river. And then the A's stadium, they've been trying to get the Oakland to help them build a new stadium for quite some time. The owner really, I don't think, was committed to the area. I think he really wanted to get over to Las Vegas. Understandably, man, it's just a bigger market. It's the entertainment capital of the world. So there's a lot of, revenue generating potential over there. So I don't think it necessarily has anything to do with Oakland as a whole. Obviously they're just not a massive metro. I think overall, if you were just to look at Oakland, I think they have like 500,000 people that live there. Obviously if you count surrounding areas, maybe a little bit more, but it just doesn't have the same economic.
No, that makes sense. I mean, look, I mean, that makes sense to me. I mean, I just don't know why even try to build? I would just redevelop the whole thing. Like, don't put a freaking stadium there. Get rid of the stadium.
Mm-hmm. They are. The goal is to scrap both stadiums completely, and then obviously focus their attention on the mixed use side of things, build it into like an entertainment complex, and then they're trying to work out a deal with some form of entertainment, because it would essentially become like a hub for people to come to from a variety of different places. And
I get that.
Entertainment makes a difference. Like
for sure,
stadiums make a difference. So
yeah, I mean, look, definitely interesting. I'd be curious what they really do believe the dirt's worth. I mean, obviously they just paid 105 mil or something like that for half the dirt. I'm curious what they. So I guess they're valuing the dirt at around 200 something mil, and interesting to see what they're going to be creating in that area. I mean, I wouldn't spend that much money on Oakland. I mean, Oakland's been horrible for 40 years. 50 years. It's been very rough. And I think, California is just, until the governor leaves, I wouldn't spend a damn dollar in California. Right. I mean, I just think it is a silly I love California. I love California. My sister lives out there. My fiance is from California. I've been out to California 100 times. I love the state. I do not like the politics there, and I think they're absolutely destroying it from the inside out. Once we have new governance and people who actually want to have people thrive in California, I would love to invest more money there. I just think it's very interesting how people continuously look like someone's going to spend $5 billion redeveloping Oakland. That is a visionary if I've ever heard of one.
Well, and there's parts of Oakland, because obviously I had a chance to stay there. One of my buddies bought a duplex. He works at Apple, so he bought a duplex in Oakland. He lives in one of them, rents out the others as an Airbnb. And so I got the chance to really go around Oakland and see. And obviously it gets a lot of spillover from San Francisco. So there's sections
for sure
of
it does.
Oakland that are literally brand new. Like they look, very high end and everything else. But to your point, there's definitely parts of Oakland that have been, underinvested in for quite some time. Luckily, they do have some pretty great universities. Berkeley is right around the corner, one of the top engineering schools in the world. So they have a lot of feeders into, different technology companies in San Francisco.
I just don't know how long it's going to be till that whole area changes. I mean, you definitely 100% you have pockets. I mean, California's weird with pockets. It's like some area you can be in LA. I mean, I don't know how many times you've been to LA, but in LA you can go 2 blocks in one direction and it's night and freaking day.
Mm-hmm. Yeah. No, DC is the same. I mean,
yeah.
There'd be set times where I got off the metro and then went the wrong way, and I walked for 2 blocks. And I'm looking around. I'm like, oh, I'm definitely not supposed to be here.
Yeah. So yeah, it's just very interesting markets like that. I'd be interested to see what they do. I'm curious.
All right. So next up is navigating the stagflation, undercutting commercial property values.
Yeah. So I mean, we've had Jamie Dimon, this head of banking, this guy from hedge fund, this guy, whatever, a bunch of huge economic players keep talking about stagflation. Stagflation's been thrown around. I know Ray Dalio has talked about stagflation a bunch of times. We're in the midst of it, right? Like this is where, we're seeing a lot of pressure, downward pressure because of rates being increased on property values, right? Like property values are really being compressed. As you can see here, there has been many times where you have these pockets where wealth is created and wealth opportunities are here, right? Obviously, if you scroll down just a smidge,
sure,
because I want to see the time frame. Okay, yeah, perfect. That's what I wanted to see. Okay, cool. So this is this just shows you the 10-year Treasury yield, and this is equity. The same store net income growth, right? So obviously this is showing you that obviously NOIs are dropping drastically because of how expensive things are getting. And obviously this just gives you guys the opportunity where, these major investment funds, this is why there's so much cash sitting on the sidelines, right? If you're wondering why there's cash sitting on the sidelines, because the 10-year Treasury, you literally have substantial upside where you have substantial returns in difference to commercial real estate, where in a lot of these deals, it's very tight. They might as well just leave their money in a 10-year Treasury, collect nearly 5% on their money, which, by the way, I mean, the Treasury has just been hovering in the mid to high 4s for a long time, right? I mean, it's been in this, if you see here, the 2022, 2023, 2024 now, it's been hovering in this range for quite some time. I don't think we're going to see it just drastically come down for a while. I mean, look, if you look at since 2001, we were actually literally almost at the same place it was in 2001, right? Which is shocking, right? It actually hasn't touched. And then, I mean, think about it. People got so freaking comfortable in this market, in the commercial real estate world, from 2011 till even until about a year or so ago. People just got so freaking comfortable with how good the market has been. I mean, it's just been straight up since 2011, right? And a lot of growth and opportunities there. What I think is possible here, and what positives to look out for are, if you're in this market and you can make great money now and you can find good opportunities right now, and you can be getting into these deals at a great basis, at a great cap rate, with value add components where you're buying it at an 8, 9, or 10 cap, and you can bring it to a 9, 10, or 11, or 12 cap. and you can ride out this wave and you can cash flow nicely. And when interest rates come down to like 5% or so, which they will, you're going to be in a fantastic position, right? This is where wealth is created. These cycles right now, right? Like this is the opportunity right now where I'm raising a bunch of money. I'm trying to find the best deals possible. I want to be invested in as many deals as possible, because if you can find great deals today, that cash flow day one with good upside, right? Like this is where wealth is created, right? In the last, call it 3 or 4 years, right? You see into 2020, 2021, even early 2022. That's where people like, that's where you can actually clearly see people got greedy, right? Where people are greedy, and like in these cycles, people got greedy, where you see the all equity same store NOI growth skyrocketed, and now they're all in trouble because they can't refi and values have gone down. When these are opportunities now where, hey, we're actually going, like, look at all the crossovers. Like this is what's interesting. Like the crossovers were in 2007 and then again in 2011. Right, these crossovers where the red line, the treasury yield, goes above the same store NOI growth, right? I think that these are opportunities. Like if you started buying in 2011, I think you would have made a ton of money if you held for the next 10 years. If you bought in 2000, let's see, right after 2007, after the market crash. I mean, like, I look at it. Let's see here. I'm going to start going through these. In 2001, if you would have bought right here, you would have done very well over the next 5 or so years, 5, 6 years, major growth. 2011, you would have had major growth. Obviously, in 2007, I mean, things just took a tumble because of no regulation. But in 2011, you would have made major money. In 2020, I think people, they went the wrong way. I think that if you bought in 2020, this is where you get hurt, right? 2021, this is where you get hurt. I think this is a great time where if you got in now, I would definitely say this is the time to buy. Hold for the next 5 to 10 years, buy great assets, great cash flow. This is where people, if you can make great money in this market right now, you will be thriving in the next decade as interest rates start to cool off.
Yeah, no, I couldn't agree more. And to your point regarding the troughs in the cycle, like, take a look at this, guys. It's not, there's a lot of people out there that are like, oh, rates are going to come down and it's going to be great come 2025. I'm of the mindset it likely won't. I mean, we're going to likely be in a period similar to this for quite some time. So it may be a 2-3 year window that you're having to navigate this. So for those of you guys who are kind of sitting on your hands and saying, it'll be better in 25, like this is kind of the new norm is kind of what I'm seeing it being. And so hopefully this gives you a kick in the butt if it's something that you need, or it kind of gives you some perspective and understanding that regardless of the environment, if you're operating in the space, all it takes is you continuing to push forward and try to, like Henry said, buy properties, contact individuals to try to generate new opportunities, but really just putting the nose to the grindstone, because these are the periods of times where I'd be interested to see like the drop off. So, if you had, let's call it from an agent standpoint, the number of licensed agent in this environment versus those that once the period of time expired, how many were left afterwards? Like there's a delta that was created. I would assume the same thing would go for investors, like value add investors during this period of time. A lot of them wash out because they're just not, they don't stick to the fundamentals, and they really focus on trying to identify new opportunities that are going to be beneficial. And so if you have that mindset and you're willing to put your nose to the grindstone for the next few years, it could really pay dividends in a relatively short period of time. So
for sure. Like, I've been telling people for a while, you need to be planning for this to be the new normal. Mm-hmm. Like if you need to be acting, working, like this is going to be the new normal for the foreseeable future. This is going to be how it is for the next 3, 5, 10 years. And if you have that kind of mindset, if and when things get better, you're going to be thriving.
100%.
So many people are just waiting.
Yeah, that's the thing I don't get. Like there's a lot of people out there. It's like, oh, I think I'll, and again, I don't know why, but it's like they'll think, oh yeah, 2025 will be better. Like survive till 25 is a lot of what a lot of people say nowadays in the brokerage community. And I'm just like, it's like, why don't you just thrive in 24? Like just focus on trying to execute today, so you don't have to worry, or so you don't have to kind of try to hit the ground running in the future that you can't predict anyways. Like, we could be in this scenario until 2026, 2027. So does that mean over the next 3 years, you're just going to sit on your hands? Like, come on. That doesn't,
Makes no sense.
that's not a proactive, like, as a
I've
business
never
owner,
said ever
that's not
I want to survive.
that's not a winning business strategy, you know?
For sure. I've never said I wanted to survive.
Yeah. That's good, man. Well, I would assume you've long since survived, and hopefully now you focus on thriving, which is what you should be
For sure.
focused on.
Take barely survive out of your vocabulary.
Absolutely. Couldn't agree more. All right. So single tenant net lease still positioned for performance. So just to describe what single tenant net lease is for those individuals who are listening that maybe don't know, these are typically the standalone retail, or sometimes they'll be industrial buildings, but for the most part, you typically see it in the retail space where you'll have like the Walgreens or the fast casual restaurants where they're nationally, corporately backed leases, 20 years oftentimes or more, once you include all the options. So they're typically traded on the market as what people, the brokers that advertise it, they say it's like buying a bond, right? But in reality, there's a lot of more nuance to it, and you have to really analyze the underlying financials of the investment. But for the most part, these types of investments attract people who don't really want to deal with any toilets or anything like that. They just buy it, set it, and forget it type of investment. And they're very, very popular amongst people kind of going into retirement. It's just a kind of another way to diversify their investment portfolio. And so one of the things that they kind of highlighted here was that as of March, the number of major U.S. markets with sub 4% single tenant vacancy matched the count from the same period 5 years ago. So what that means is that the market vacancy for these types of opportunities is almost the same as it was back in 2019, when again we were still at a very a very favorable environment. Retail spending is obviously still higher. We could debate all day long about whether or not that's just inflated. I think it probably is. There's a lot of people out there spending money on credit cards that they may or may not have, but obviously that still translates to spending in the economy. So a lot of these retailers are still doing very well. One of the characteristics of these investments, as they said before, that makes them attractive is they typically trade between $1 million and $10 million, which is, accessible for a lot of private investors. So as we said before, it's not uncommon. I've got a couple of clients that I helped sell. I sold this year. I sold 3 single tenant net lease properties. One of them was a business owner friend of mine who I've sold several properties to in the past, and he just buys these properties up, pays them off, and lets them set it and forget it. Another buddy of mine owned a business, sold it in the past. He's also a developer out in Newton, Nebraska. I helped him buy a Pizza Hut deal, triple net, 10-year lease, etc. And again, these are the types of people that often end up buying these types of properties. And granted, you can get some institutional players involved in that range, but most of the time they're going to be buying a lot bigger properties. So anyway, so this is just some perspective to share that, there are still sectors of the marketplace that are performing at a high level. And it seems that, the highest performing ones, in particular in the single tenant at lease space, is fast food, convenience stores, restaurants are all performing really well. And I guess their vacancy rates are sub 3%. So it's kind of crazy.
Yeah, I think that, look, I love triple net deals in the right circumstances. You know why I like them? Because I like finding these, negotiating great triple net deals, and then selling them off, right? Where if you can find these, I like flipping these types of properties, right? Because if you have a great buyer on the back end who will buy it at an X cap rate, you can lock them up at substantially below that kind of cap rate, or I guess substantially above it. You can make some great money. I mean, these are opportunities where, I think they're great for 1031 clients. I think they're great for retirees. These are fantastic options for them to sell their, get them to sell their current property, get them to, get out of those properties, get them for good prices, and then flip it into a triple net. And keep in mind, guys, I look at triple net from the lens of an investor first, or even as a wholesale deal, right? If you can find these types of deals and lock them up at 8s and sell them at 7s or 6.5s or 6s, there's a lot of money to be made. Right. And I think that, keeping in mind that hey, it's not just about listing these properties. There's a lot of value in thinking a little bit more creatively and locking them up. I try to do a lot of lease backs to try to set up triple net deals where you have single tenant single tenant, industrial, single tenant, retail, where they're owner occupants, so they're going to sell it and then do a lease back. Definitely an amazing way. Like I'm working on one right now, which I'm waiting to hear back on. I should hear back on hopefully the 1st of June, but I should be buying it at a day 1 12 cap, right?
Awesome.
In my market. So like the goal is that we'll lock it up and then I'll sell it, probably within, either same day as a wholesale deal at an 8 cap, or I'll buy it, lock it up, sign a long-term lease, hold it for the long term and refi and hold it cash free. Right. So anyways, it just, those types of opportunities are massive. You just got to see them like a little bit differently than the masses.
Yeah, 100%. And really, there's a lot of investors out there nowadays, they don't necessarily want the 20-year lease. They'll start looking at these properties that have like 2 years of term left or a year of term left. And maybe that market has a sub 3% vacancy rate, which means that they could either if once that lease expires, they can go back to the tenant and say, hey, we're going to jack your rent up 30% because that's what the market is. And if they decide to leave or they don't want to renew, then that gives you an opportunity to try to bring the property back up to what market rate is at that point in time as well. So, that's one thing we're doing with a client of mine right now is we're trying to find properties in that category. We had one under contract. Unfortunately, we weren't able to kind of make the timing work on it, that they needed a much quicker timeline than we were able to do. But again, that those types of opportunities are out there. And if you're willing to capitalize on them, it could be a pretty beneficial one to pursue. So
for sure. I mean, look, and they're great. If you have a buyer who likes them, that's a great buyer. That's a fantastic buyer.
Definitely. All right. So one last one that I'll share here, kind of just adding to the just general discussion, is related to the immigration clouds. So understanding the different generations and how those trends could affect the future of real estate. So, obviously, correct me if I'm wrong, Henry, but I believe you and I both belong to the millennial generation, which makes up roughly 21.7% of the population. What's interesting about the millennials, which I didn't know, is I guess they have the second highest birth rate in American history. So, if I'm not mistaken, the second highest birth rate. Maybe I misinterpreted that. I don't know if that means like we were the generation that had if you compare the total size to baby boomers, I think we are the second largest of all time when it comes to the U.S. Now with Gen Z, which is the next generation after us, they were kind of describing them as a smaller piece of the total population, and because of that, it's affecting a variety of different industries. Obviously, less people are deciding to go to college for obvious reasons, the biggest being the cost of education and the lack of opportunities thereafter. So you're starting to see a drop in enrollments. And so again, I think what the reason I wanted to share this, and it doesn't necessarily have a ton of information, but at least gets you thinking about how different demographics impact different industries and how is that going to translate to all different types of businesses going forward, whether it's housing, consumer goods, jobs, etc. So again, that's why looking at some of this information, especially if you're starting to invest in different markets and getting an understanding of the trends in different demographics, is important. So thought I'd share that.
Yeah, for sure. I mean, I love reading this type of stuff, and I also think I like the migration patterns. I think it's really important to be paying attention to where money is being poured into. Where I like to follow trends. There's a lot of value in understanding. Like, listen, great to understand your local market, great to understand one asset class, but like in this type of economy where you need to be nimble, where you need to be on your toes, both technologically, because with ChatGPT and like AI coming through, right, as well as economically, right? Asset classes go through these cycles, right? Technology is going through another cycle right now. And if you just act like you can focus on one asset class and one little marketplace or one type of technology, you're going to be left behind, right? And these are constant reminders like, hey, find out where the money's being poured into, what asset classes, what locations, who's your buyer, right? Because there's going to be cycles of buyers being like, in the next 20 years, the main buyers are not going to be the main in your marketplace. I'm saying, not talking about Blackstones and Vanguards and whoever in your marketplace. There's going to be a different clientele who's going to be buying those properties, right? Like the people who are the big players right now are probably not going to be the big players in 20 years. And you need to be constantly paying attention to those cycles of who those players are, where they're coming from, what areas are investing in your local markets, and capitalizing where you can.
Definitely. No, I couldn't agree more. But yeah, I mean, I appreciate the conversation. I think, we've gone through several different articles that I think were very pertinent, and hopefully you guys gain some value from this discussion. Again, if you guys have any questions or want us to cover any articles in particular, don't hesitate to kind of type away in the chat box. And even if you guys watch this after us recording, obviously we want to still get your feedback. So feel free to type away. We do review all the comments and everything that we receive. So.
Yeah, and thank you, Tom, for all the comments. We appreciate you, man. Thank you for basically commentating with us. We appreciate that. So anyways, guys, thank you for tuning in. As always, I'm going to be actually off the next 2 weeks. I'm going to be flying to Italy. So I appreciate you guys, following the channel. So, subscribe, obviously, to the channel you're watching this on. Check out Rafael's platform, my platform. Check out all the content. We appreciate you guys, and we'll see you guys next week. Take care.